In an inflationary environment, traditional fiat liquidity deteriorates. This forces institutional capital to seek refuge in hard physical assets that maintain their purchasing power. But hard assets present a unique problem for high finance. The public market for collectibles is driven by aesthetic whims and subjective day-to-day demand. This inherent volatility makes raw, uncertified collectibles unsuitable for use as rigid institutional collateral. A lender cannot underwrite a loan against an asset whose value depends on the opinion of a single collector. To solve this, financial engineers are structuring physical coins into digital collateral that complies with the Uniform Commercial Code. This transformation requires engineering object truth into the asset, creating a mathematically verifiable and legally unassailable chain of evidence. To generate institutional liquidity, the process must strip the subjectivity out of numismatics and replace it with forensic law. The foundation of this system is built on the American Numismatic Assassination's advanced methodologies. These standards, taught in the Aristotle's Vault series, provide the objective rigor required to verify an asset's physical state. The RSI protocol acts as the commercial framework, translating these numismatic standards into a closed network financial architecture. We are going to deconstruct the microscopic grading, the 12-phase verification protocols, and the legal contracts that enable a mathematical value multiplier. Deep physical authentication is the non-negotiable prerequisite for creating digital financial liquidity. Developed by Dr. William Sheldon in 1949, this scale replaced adjectives with a rigid 1 to 70 numeric taxonomy. Technical grading focuses on the lower levels, deducting points strictly for physical wear. Market grading introduces high variance characteristics like luster and strike, shifting value exponentially in the upper tiers. The AU58 paradox demonstrates how these nuances in market grading can invert technical valuation. A coin graded MS62 is technically uncirculated, but it can be covered in deep scratches and bag marks that degrade its visual appeal. An AU58 coin features microscopic friction on its highest points, technically disqualifying it from mint state, yet its surfaces may be otherwise flawless. Because the AU58 often possesses superior eye appeal, the market frequently values it higher than the technically superior MS62. Strike sharpness acts as a similar multiplier. On a standing Liberty quarter, a full head designation, requiring a visible hairline and ear hole, dramatically increases the asset's value through strike quality alone. Since single-point grades and strike characteristics dictate massive capital shifts, grading must be treated as a forensic science. Independent third-party grading services like PCGS and NGC provide the baseline authentication needed to eliminate conflict between buyers and sellers. However, these grades are subject to gradeflation, the tendency for standards to loosen over decades. A coin graded in 1988 may receive a higher numeric grade if resubmitted today. Because these high grades represent immense value, counterfeiters specifically target a coin's physical architecture to bypass standard database checks. This creates a dangerous vector of targeted mechanical alterations that are far more difficult to detect than simple crude fakes. For example, the U.S. Mint never struck a gold Indian head half-eagle in 1919. This coin's incuse design, where the date is sunken into the field, creates a unique opportunity for fraud. Counterfeiters gouge the bottom of an authentic 1913 coin to form a 1919, but a forensic review reveals the inherited upward curl. Serial number checks cannot stop these physical alterations. True collateralization requires expert intervention before an asset enters the chain of trust. Even a verified coin is legally insufficient for institutional finance without a verifiable chain of custody. The 12-phase notarial protocol bridges this physical artifact into a controllable electronic record. Relying on the triad of trust, it divides duties between the notary, the mason, and the numismatist, preventing any single actor from committing fraud. Phase 4 mandates immediate photographic documentation and secure packaging during intake to freeze the asset's state. Phase 6 then requires a mandatory expert referral designed to identify mechanical alterations that standard labels might miss. In phases 7 through 9, all photography, declarations, and verifications are compiled into an evidence manifest and formalized as an authentic act. This file is then anchored to the blockchain. A SHA-256 cryptographic hash creates a unique digital fingerprint of the entire evidence manifest. By anchoring this hash to notary chain, the protocol provides an immutable timestamp, proving the evidence file existed in that exact state at that time. This elegantly solves the oracle problem. While the blockchain ensures the integrity of the record, the 12-phase protocol ensures the truth of the physical asset within that record. This cryptographic process fulfills the requirements of UCC Article 12, transforming the physical object into functional digital collateral. The RSI protocol then engineers the Sheldon scale into a literal multiplier for commercial collateral. The valuation is derived through an explicit formula: base retail value multiplied by the Sheldon grade. For example, a $30 grading cost multiplied by a perfect MS-70 grade generates a revalued market value of $2,100. Attempting to sell this revalued coin on an open market like eBay would result in failure, as that market remains subjective and volatile. This revaluation exists strictly within a closed commercial ecosystem. Participants operate under a shared architectural trust, governed by mandatory asymmetrical arbitration clauses embedded within their contracts. Lenders and trustees legally surrender their right to debate the collateral's value, agreeing in advance to accept this objective formula as the unchangeable standard. The RSI protocol uses contract law to permanently enforce the object truth established by the numismatist. The trust architecture is now complete. Physical perfection is identified by the numismatist, encapsulated by a grading service, and cryptographically bound by the notary. This unassailable chain of custody allows commercial contracts to mathematically multiply the asset's value without the risk of open market fluctuations. The ANA's e-Learning Academy provides the technical groundwork for this process, training students to identify the microscopic data points that underpin institutional trust. This forensic training is a prerequisite for operating modern asset-backed commercial infrastructures. In institutional finance, the ultimate value of collateral is not the metal itself. It is the mathematically verified, legally binding chain of evidence engineered around it.